Let's take a look at the fixed income space now. Jim Stening joins us from FIIG Securities. Jim, I suppose just to start with, last week we saw the announcement of the primary healthcare bond issue. Some question marks over it a little bit. Do you think the criticisms of it are fair?
Well, I suppose, there has been a lot of discussion in the media about this deal. I suppose with the benefit of hindsight, the company or the issuer has gone back and restated the prospectus. So I'd have to say that they saw that as being a requirement. So I'd have to say yes is the answer to that.
And the revised document, is it an improvement?
Oh, look, most definitely. I think I don't necessarily think that the changes that were required were in response to something that was deliberately misleading, but I do think that anything that can make the decision process or information clearer to investors should most definitely be embraced.
And what was that the issue at heart here? You know, the clarity of it.
Look, I think so. I mean, a lot's been said about the structure. I mean, this is obviously always going to get a lot of airplay because it's the first deal to come through this new relief that ASIC have offered with the short form prospectus. So I guess it's been picked over very in great detail by a whole range of analysts. I think one of the interesting things about this is I think that we need to sort of take a step back and look at that. I mean, there's a hell of a lot of disclosure and a hell of a lot of I suppose comment about how that has been disclosed. But I suppose the interesting thing, I think, from the regulator's perspective is that for people or retail investors to get access to equities, they're satisfied with the ongoing disclosure rules of the ASX as that being adequate. So it's quite an ironic thing to think that when you're in an investment that is actually more secure and sits higher up in the capital structure, that such extensive disclosure is actually required.
And is that something you think that is interesting to come out of it, the level of disclosure needed now through these new ASIC rules?
Well, I would argue that the interesting thing is a transaction-specific prospectus for the issue of equities is less onerous than what this prospectus is, or this relief that ASIC has designed. So I think that it's certainly a step in the right direction in that we now do have shorter form prospectuses. But I would argue that whatever's required for continuous disclosure for equities should be more than adequate for debt holders.
Well, obviously, as we've sort of covered it, disclosure a big issue at the moment, and really in the spotlight. What else do you think can be done to improve disclosure?
Well, I suppose not much. I mean, I think the idea with disclosure is to be full, open, and frank. And I think I suppose it comes back to this central point. If the regulator is happy with a continuous disclosure through ASX listing rules, for that to be adequate for a retail investor to put their money into an equity. And by the same token, if absent a government guarantee, APRA, the regulator, is happy for investors to put their money into a credit union or building society, then that should suffice for bonds as well.
Now, the offer did open yesterday. Are you expecting there to be good demand?
Well, look, yeah, I mean, I guess this is not something that we're involved with, but by all indications, this has been a very, very successful issue. Institutional demand's certainly been there, so I think that's really the major test, and I suppose that demand speaks volumes.
So widely, broadly, do you think there is that a real appetite for bonds and for a bigger bond market?
Absolutely, no question. I think this is an interesting thing. It was the first cab off the rank with the using the new relief. I think there's a lot of people eyeing this market, the potential for this market. It's something that will develop over years in this country.
Do you think this highlights the need for a retail strategy agency as well?
Look, that's really important. I think obviously one of the things that's also been talked about a lot is access to credit rating analysis, and I know that there's been a group set up out of Melbourne recently to cater to retail investors. But look, yeah, I mean, I think it's that's a very unusual situation, I think, and one that is an opportunity, I suppose, for these rating agencies. Difficult to understand the model and how that would work, but.
Just, I suppose, still on the bond market, we yesterday had those better than expected GDP figures. Look, what sort of impact does that sort of have, do you think, on the bond market?
Well, I think it's a bit of a heads up. I mean, I think one of the things that we do is we watch very closely the RBA, RBA speak, And the great thing about the RBA, as I always say, is that they're very transparent. And one of the things that I think that was highlighted as a great development or a great emerging development was the savings trend that emerged through the GFC. And what we've had yesterday was a clear reversal of that. And so I think that is a heads up. I think that the bias will be towards tightening towards the end of the year. So overlaying that into the bond market, I think the bond market, particularly long duration bonds, are excessively overpriced. So I expect to see some weakness there, and I think, underlying that obviously is strength in global debt markets, and I'm not a big believer in the double dip, so therefore not a big believer in lower yields across US Treasuries either.
Well, I suppose that sort of segues well then in terms of the US bond market, these record low yields. Do you think they are sustainable? Obviously not.
Well, look, no, I don't. I think certainly the sentiment has been that it's a very negative outlook. But I think what we're hearing, albeit in opaque terms, is that the Fed is focused on reinflating the economy.
Yeah.
So I suppose if you're taking a view that we're going to have deflation and that yields are justifiable where they are, you're really betting against the Fed. And I suppose, I suppose that might work in the short term, but I'm not necessarily convinced that it's something that will happen in the long term.
Because we've been hearing a lot about, bond rallies and so forth over in the US. Is there any substance to that, do you think?
Well, obviously, I mean, the
bond bubble, maybe I should.
Well, look, I think that's right. I think in previous recessions we've seen fairly dramatic retracements in long-term fixed income. I mean, generally speaking, it's a flight to quality that's driving these things. So yes, I would expect, but generally that's associated with a V-shaped recovery. The jury's out on the shape of the recovery at the moment, but nevertheless, I think there will be one.
All right, Jim. Look, thanks very much for coming in this morning. Great to talk to you.
Thanks, James.